Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. Welcome to Next Level Charting. Glad you could join us. This is the show that is designed to take your charting skills to the next level. You can watch every Thursday at noon Eastern Time, or you can watch on demand on our YouTube channel. And if you like this video, please give us a thumbs up. So today we're going to look at the aftermath of big down days, because if you look at these 2-day 5% declines over the last 10 years, it looks like you need some time to recover. The stock market is feeling a bit like Wilder after being punched by Fury. We'll look at some pullbacks and bounces that occurred after these big declines, the possibility of a retest, and of course the current outlook for the S&P 500. So the stock market is feeling a bit like Wilder probably felt in the third round when Fury landed a good combo and knocked him to the ground. And it happened again in the fifth round when Wilder was also knocked to the ground. I don't know if you saw the fight, but I just watched some of the highlights. And the market is kind of feeling a bit like Wilder right now, trying to find its feet and maybe in need of some time to rest. And so what I did is I went back and I look at the previous times when the S&P 500 fell more than 5% in a 2-day period. And I also looked at when it rose more than 5%. And as you can see on the chart here, there have been 3 2-day advances that were greater than 5%. And those are marked, well, they're not marked, but you can see them there on the chart. And then there have been 10 2-day declines greater than 5%. And you can see there was a cluster there in 2011. That's when we had the European sovereign debt crisis. And then you can see we had another one in August 2015 there. We had another one in July 2016, another one in early 2018, another one in October 2018. And here we are now. We're down over 6% in 2 days. So it's interesting. You see this occurs more often in a bull market than in a bear market. Your definition of a bull and bear market may differ, but we did move into some bear periods, I think, here at least 3 times. You know, in 2011, that was a bear period. 15, 16 was a bear period. And October, November, December 2018 was a bear period. But if you see the little blue spots on the S&P 500 chart there, well, that shows that it took some time to stabilize after you got hit there. In the first hit there in 2011, after the first hit in 2015. This is Brexit here, the one in July 2016, the initial Brexit vote. Remember that? Long time ago. So we had an immediate recovery after that one. And then we needed to recover after the 2018 decline. And then you can see the one in October 2018 led to a consolidation. You had to find your feet again, but moved down after that one. So if you look at these, you can see at the very least, we're due for a period of choppy trading as the market finds its feet. So I think we can learn from prior pullbacks. Now, no 2 pullbacks are going to be exactly the same, but there will be some rhyme to into what happens. And so I'm looking at these 5 times that I've marked on the first chart when the S&P 500 declined over 5% in 2 days. That's kind of getting broadsided by a left hook from Fury, basically. So if you look at this chart here, this is the first one, the sovereign debt crisis in 2011. That's that big, sharp decline. And then you had over 40 days of choppy trading. And this was some of the most choppy trading ever. I remember these swings. They were extraordinary. Big swings to the upside with strong breath, big swings to the downside with strong breath. And you finally got the breakout there. And then we got what I call the golden pullback. And that's the thing about the stock market and trading is you have to have a little bit of patience and let the market come to you. And if you see this breakout here, it looks good. Sure, you broke resistance. And if you've been playing the breakout, well, you would have not been feeling very good back around 1175 if you'd gotten in up here around 1225, 1250. So back at 1175, oh man, this is failing. And that's why I think when it comes to these shorter term setups, and this would be a shorter term setup, mean reversion is the way to go. So the breakout was longer term bullish if you play the breakout, okay? But you're going to have some patience on that. And if you look at the pullback, the reason I call it the golden pullback is because you had this advance and then you retraced 61.8% almost exactly. And that is the Fibonacci 61.8%, the golden ratio there. And then you got a breakout. And you had another pullback here to play and the breakout. So you had two pullbacks that were playable. And I bet you if you measure it here, that's going to be about 61.8%. But the point is, you get the breakout and you say, okay, we're going somewhere now. You're still below the 200-day there. But then you get here and you get that surge. That's a signal. You get here, you get that surge. That's a signal to look for. So that's something to look for in the coming months. This isn't going to happen overnight here, but it's something to look forward to. All right, so now I'm going to move to 2015, and we can see there in August we had that sharp two-day decline that was over 5%, continued down a third day, and then finally got the oversold bounce, tested support. So basically after that initial decline, you had one more, and then it took over a month to stabilize, 34 days roughly, 23 calendar days in a month. So this is what happens. You get hit, knocked to the canvas, and you need some time to get your footing back. So the test of the low is sometimes a place to look for a bounce. We got a breakout here, break above the 200-day. It looked like a normal flag-like correction here in November, December, but instead of breaking out, we continued lower, didn't reverse at the golden ratio there, and moved below the lows. So we had two lows there in January, February 2016. So here's the anomaly of the group that I'm showing here. It's the Brexit vote. You had the market, it looked like, the market was working its way higher, doing fine. And then you had this Brexit surprise vote where the UK voted to leave the EU way back in 2016, seems like eons ago, broke the 200-day, and then you had the sharp snapback rally. So then you moved to a new high. And here we had another golden pullback. The market worked its way lower. This looked like an opportunity here as well. Not all opportunities work, though. You can see you had this breakout zone turn support, and it looks like we're going to get a bounce here, but no, it continued lower. Kissed the 200-day there, got near the 61.8% retracement, and had that surge to lift off. So that was a signal there to look for. But again, there's usually a pullback if you have a little bit of patience. So now we move to 2018. And as I've noted before, the market seems to be channeling 2018 because if you look at this, and I pointed this out before, you had this normal advance and then we went parabolic here. And that's kind of what happened here in January, February of 2020. We kind of started getting excessive on the gains. The S&P 500 was almost 10% above its 40-week EMA. And so then we got that two-day decline that was greater than 5%, and we continued lower. And even though we continued lower, we held the 200-day for the most part. Sure, we got below it in April. But again, the main point to remember here is you got broadsided here, and it took the market over 40 days to really find its footing. Sure, you had a bounce, but you had a retest, and that's another theme. So there's basically two themes that are emerging here after these kind of declines. First, it takes over a month to stabilize. Second, you often get a retest of the low. So you get a bounce, and you get a retest, and that retest may offer an opportunity. And then the third one, as I pointed out, you had two times where the market had a nice correction back to the 61.8% retracement, and you got a surge off of that retracement. So that's something to look forward here. We'll get to the 2020 chart next. But you can see here the market stabilized and then started working its way higher. Now here's one that's a little bit different than the other ones because you can see you had a strong break below the 200-day, and then you got a bounce, but it was the golden bounce because it retraced 61.8% of that decline, and then we started lower again even though we had another bounce. But if you look at the pattern that was taking shape there, it's a triangle. So basically you're hit hard and then you consolidate, and that is a bearish continuation pattern. And then we broke down again in late December 2018 and hit that new low with that famous December decline. I believe that was Fed related. You know, a lot of these declines, we don't even remember what caused them. I can't remember what caused the January 2018 decline. I could probably look it up. But I usually don't pay attention to the news. Coronavirus does not influence my trading decisions. I just look at the charts. The Fed does not, well, I do follow the Fed balance sheet. And when it's expanding, I don't like to fight the Fed, and it is expanding. But this one, again, was different because you can see, again, the sharp decline, consolidation, and breakdown. So that could be the case now. We could move sideways. But you can also see here that, you know, after the initial bounce here, we had a retest and you had another bounce, but this one had a lower high and a breakdown. Hey, I just want to point out the symbol summary page at StockCharts. If you enter a symbol up there at the top in the symbol entry box and choose symbol summary and go, you're going to get a nice overview of the stock right up there at the top. You get a chart. You get a summary with some technicals there, fundamentals, technicals, more technicals. You get a scooter rank. And if you know about the stock, especially if it's a smaller one, you can read about it in the company description. So this is a really handy page. So what about the market now, the S&P 500? Well, it is very oversold. RSI, 14-period RSI, has been below 30 like a dozen times or so over the last 10 years. So when it gets below 30, that's really an oversold reading for 14-period RSI, which is at 28.57. You can see the 4-day rate of change is below minus 5%, and you had that double occurrence there in early August when the 4-day rate of change went below minus 5% and RSI was below 14, and you're just above the 200-day. So you had a bit of a consolidation and a bounce and a test. Now, I'm not sure where the market is going to find its footing, but I think it's going to be sooner rather than later for the initial bounce. And the ideal spot is right here around the 200-day. You can see broken resistance turning into support, and you're already oversold. So I think the odds of at least a little bounce are really increasing. But I still think we're going to need a month or so to stabilize. And that's why I added 40 days to this chart. And 40 days goes out towards the end of April. So it could take that long to stabilize, and we could see choppy trading until then. So that concludes this edition of Next Level Charting. Remember, you can watch every Thursday at noon Eastern Time on StockCharts TV or on demand on YouTube. And if you like it, please give us a thumbs up. Thanks very much for tuning in, and have a great day.